Greetings everyone and welcome back to our Forex mentorship program for beginners. Today we are going to be looking at some Forex terminologies. You will agree with me that every field of specialty out there is always governed by a body of terms and Forex is not left out. There's absolutely no way you are going to trade the foreign exchange market without talking about these terms you are going to look at today. And the first amongst them is a PIP. What is a PIP? A PIP is the smallest unit of price for any currency. It is always the smallest increase or decrease in price. It is always very, very unnoticeable. It could move by 1, by 2, by 3, and you cannot actually make money with pips in the market. You make money with volume, and we are going to look at that. Now, for major currencies, excluding the Japanese yen currencies, it is always denoted as the fourth digit. How is it gotten? We are going to look at that when we start doing calculations. It is denoted as 0.0001. This one here is the PIP. This one is the PIP, which means if Euro USD moves from 0.0001 to 0.0002, it means Euro USD has increased by 1 PIP. If it moves from 0.0001 to 0.0003, it means Euro USD has increased by 2 pips. From 1 to 3, 2 pips. For the Japanese yen pairs, it is denoted as 0.01, where the second digit is a pip. So if price moves from 0.01 to 0.02, it means that's increased by 1 pip. That is how we measure pips in the foreign exchange market. And they move very small. You cannot actually make money with pips. Let me show you, for example. Let's look at Euro USD. In Euro USD, this is a pip here, this fourth digit. If Euro USD moves from 1.0951 to 1.0952, it means Euro USD has increased by 1 pip. That is what we call a pip. Now, if Euro USD moves from 1.09549 to 1.0948, it means Euro USD has decreased by 1 pip. If it moves from 1.0949 to 1.0947, it means it has decreased by 2 pips. So that is a pip. I hope you understand. Let's look at the Swiss, for the Japanese yen. The Japanese yen, like we said, is always a second digit. So if the Japanese yen moves from 170.01 to 170.02, it means it has increased by 1 pip. If it moves from 160.92 to 160.91, it means it has reduced by 1 pip. So for the Japanese yen pairs, it is always the second digit. But for the pairs that contain the US dollar or the major pairs that do not include the Japanese yen, it is always the fourth digit. I hope that is clear. Let's look at PIPETTE. PIPETTE is 1/10 a pip. It is actually very, very, very small. It is always the fifth digit. Now, every currency pair is always represented by 5 digits. Remember, the fourth digit is the pip and the fifth digit is the pipette. It is actually very, very small. It is not always, we don't use this in trading. We don't use pipettes in trading. So, for example, if Euro USD moves from 1.3 to 156 to 1.3 to 158, it means it has increased by 2 pipettes. From 6 to 8 is 2 pipettes. Let me show you a pipette. A pipette, this is the pipette, the fifth digit. The fourth is a pip, the fifth is a pipette. 1.0992. The fourth is a pip, the fifth is a pipette. So if it moves from 1.09921, it means it has increased by 1 pipette. I hope you get it. If it moves from 1.09922, it means it has increased by 2 pipettes. But we don't really consider pipettes in trading. We pay much attention to pips. So don't bother about pipettes. Thank you. Let's look at what is a lot. A lot is actually a volume. Forex is commonly traded in specific amount called lot. Now, the thing is, you don't make money trading pips. You can only make money trading lots because lot is like quantity. It is a unit that is used to measure amount of transactions. It's like buying someone who goes to the market and buys an egg, and someone who goes to the market and buy boxes of eggs. So it depends on what quantity you are going to buy. So a lot is simply, it defines quantity. What quantity or what amount of currency are you willing to buy? That is a lot. We are going to look at that and I will show you. Now, there are four categories of lots, four major categories, but only three. We use only three. The standard lot is measured as 100,000 units of currency. The mini lot, 10,000 units of currency. The micro lot, 1,000 units of currency. And the nano lot, which is 100 units of currency. We are going to talk about that in details. So when you are buying a currency or a currency pair, you are not only buying pips, you are buying quantity. Now, how do you do that? I am going to show you. These are lots here. When you want to buy or sell gold, you are buying in quantity. So you can come here and you change from 1 to 2 up to 10. It depends on how much quantity of gold you want to buy. You modify it here anytime you want to place a trade in the foreign exchange market. So lots are actually quantity. They are volume, amount of measurement for any quantity or any currency that you want to buy in the foreign exchange market. I hope this is clear. We are going to do a lot of calculations on lots. I don't want to get into calculations now, please. There's so much. You are going to know the value of 100,000 units of currency. You are going to know its volume, and you are going to know all of that. For now, let us keep it here. We will not talk about it so much. We'll come back to this. I don't want to scare you with calculations. There are lots of calculations, but we'll come back to it. Just keep it. For now, what is a bid price? A bid price is a price at which the market is buying and you are willing to sell, like right away. If you step in the market and you have a currency pair and you want to sell it, at what price are you willing to sell? At what price is the market buying, and at what price are you willing to sell, like right away? I am going to show you. This is the bid price for gold, 2050.00. It means if you step in the market, you are willing to sell gold at this price. Price is called the bid price because this is a price the market is buying at and you are willing to sell it out at this price. 2050.00 is the bid price. So a bid price is a price at which you are willing to sell a currency, and it's the price at which the market is buying that currency, like right away. What is the ask price or the offer price? On the other hand, the offer price is the price at which the market is selling and you are willing to buy at that price. It's an offer. The market is selling at that offer and you want to buy. Like if you step in the market right away and you want to buy a currency pair, how much are you willing to pay for that particular currency? That is the ask price, the price at which you are willing to buy a particular currency, and it's the price at which the market is selling. For example, this is the ask price. This is the price at which the market is selling gold at 2050 and you are willing to buy at 2051. So this is the price at which you are willing to buy. It is called the ask. Remember, this is the price you are willing to sell. It is called the bid. The price at which the market is buying and you are willing to sell is called the bid. The price at which the market is selling and you are willing to buy is called the ask. This is the ask price, 2051.00. This is the bid price, 2050.00. Do not confuse, please. Now, the bid and the ask equals the spread. The difference between the bid and the ask is a spread. Let me show you. Let's take, for example, Euro USD. The bid price here is the price at which you are willing to sell Euro USD is the bid price, 1.0949. What is the price at which you are willing to buy Euro USD, which is the ask price, 1.0951. If you subtract 51 from 49, you are going to have 2. So the difference between these two currency pairs is the spread. The difference between the bid and the ask is the spread. The difference between the price at which you are willing to buy and the price at which you are willing to sell is called the spread. I hope you are understanding. Now, margin. What is margin? Margin is simply a down payment. Margin is a collateral. If you step in the market and you want to buy a particular currency, now your broker will tell you, no problem, you are going to buy, but before you buy, you are going to make a down payment. And this down payment is always directly proportional to your account capital. If you have 100,000 units of currency and you want to buy Euro USD, your broker will tell you, you are going to give me 1% of your capital, and I will set aside for these trades you are going to take. Remember that the margin is not deducted from your account. Margin is just money that is set aside before you can take a trade. When you close that trade, this margin is going to be refunded into your account. Let me show you an example of a margin. Look at this. This is a margin. This is a trade that is currently open, and this is a margin. It means for all of these trades that I took, this was my collateral that was calculated. I needed to put in $317.38 as collateral before my broker could permit me to take all of these trades. Before you take any trade, your broker is always going to take a collateral for that trade, and this collateral is called the margin. I hope you understand. Let us look at leverage. Leverage is simply an account multiplier. Remember, in the history of money, we said we could not have access to the big banks because we do not have capital. Brokers came up with this idea of saying, oh, if you bring a small amount of money, I am going to multiply it so that you can add to your money and then have access to huge capital. For example, it is always given in percentage, don't forget. If you bring $100, for example, and your broker is offering a leverage of 1:100, it means your broker is willing to multiply your $100 100 times. So instead of you controlling just $100, you are going to control a position of $10,000 because your broker has lent you money and has multiplied your capital. So a leverage is simply an account multiplier, and it is always given in percentage. You can have a leverage of 1:2, 1:1, 1:3, 1:4, 1:5, 1:20, 1:50, which means if you take a leverage of 1:100, it means that for every margin that you place, your broker will multiply your account 100 times. We have brokers that will give leverage up to 1:1000, which means if you come with $100, your broker will multiply that $100 1000 times, and you will be controlling a position of 100,000. So brokers give leverages so that people who do not have capital can be able to manage a lot of capital in the market. But leverages are two-edged swords. We are going to talk about leverage very well when we start doing calculations. Do not worry about that. So for now, just know that a leverage is an account multiplier. It is money that your broker will give you so that you can be able to control larger positions in the market. I hope you understand. Unrealized profit or floating profit. Unrealized profit equals the number of open positions that you have. It could be profit or it could be losses. Let me show you. This is what we call unrealized profit. Okay, this is unrealized profit because these trades are not yet closed, so they are still floating. They are still floating. Unless you close all of these trades, you are not yet in profit because you can still lose all of this money. So this money is unrealized. Until it is closed, it is unrealized. It is not yet your money. Okay, that is the meaning of unrealized profit or floating profit or loss. It could be a loss, it could be a win. For example, this is another example. All of this is unrealized. It is floating. These are losses. Okay, it is floating. Until you close all of this, it is not yet your money, or it has not yet been deducted from your account. Okay, so this is unrealized profit or floating profit or loss. It could be profit, it could be loss. Let's look at balance. Balance is simply your capital, okay? The capital that you come with in the market to trade. If you are depositing $100, that is your balance. If you are depositing $10,000, that is your balance. If you are depositing $1 million, that is your balance. You are going to look at it also. When you create an account, you are going to have this. This is your balance, account balance. It's also called account balance. This is it. 2,380. This is my account balance. Simple. It is simply the money that you have deposited in your account so that you can use that money to trade. That is your balance, okay? I hope you understand. Let's talk about equity. Account equity, net asset value, net equity. What is equity? Equity is simply your account balance plus your floating trades, okay? It could be profits, it could be losses. Let me show you what an equity is. Let's go here. This is equity. This is your equity. This equity is equal to all of these trades opened plus your account balance. Your account balance is 2,380.07. This is the account balance. So equity is simply the combination of your opened positions, either losses or gains, plus your account balance. If you close this trade now, this profit is going to be added onto your account balance, and your account balance will be increased. But if it is not yet closed, it is still your equity. If you are in losses, it is also going to show your account balance minus your losses, okay? You are going to see it here. So you always see it here every time you open your trading tool like the MetaTrader 4 or the MetaTrader 5. It is always shown here. I hope you are understanding. Free margin. Free margin is the money that is not locked up. Yes, if you have an account, okay, an account balance, and your broker tells you to deposit a particular amount of money before you can take a trade. For example, if you have $1,000, your broker tells you to deposit $100 before you can open a position. You still have $900. So this $900 is your free margin. In case you are running out of margin, your broker will go into $900 and remove 100. So the money that is required for that trade to play is 100. So the remaining 900 is your free margin, and your broker can go into that 900 at any time, remove 100 from there and keep as collateral. So free margin is money that is not locked up. Let me see if we can see it. This is free margin, okay? If you divide this money 2,135 by 317, it's going to tell you the number of trades that you can still open with this money, with this free margin. So free margin permits you to take more trades. If your free margin is more, you can take more trades in the market. I hope you understand. Margin call level is a specified level percentage where if your margin level is equal or below it, you won't be able to open any positions again. Now, for the margin call level, when your account starts dropping, for example, if this is your free margin, right? You said our free margin is 2,135. If we go more than below this level to a point where we do not have enough margin again, it means our margin level has depreciated. So we have to stay above $317 because this is the amount required for us to be in this trade. So if we go below this $317, it means our margin level has dropped, and it is possible that we may lose that account. Let us look at stop out level. Stop out level is that specified level or percentage where if your margin level is equal or below, your broker will automatically close your positions. Yeah, it becomes when you get to a stop out level where your margin level completely runs down below your margin, then it is very possible that all your trades will be shut down. Your broker will tell you, no, you do not have enough money again or enough collateral to be in this trade, so we are not going to hold you. We are going to close all your positions. You will understand all of this when you start trading. Do not worry. Let's look at the last one, which is the margin call. A margin call occurs when you have breached the margin call level but still above stop out level. A margin call is simply a warning that your broker will send to you. If your account balance has gone below and you do not have enough margin again to stay in the trade, then you are going to receive a notification from your broker telling you you can no longer be in this trade again. You are going to close your positions. And this varies with different brokers. So it is always very important that before you create an account with a broker, you need to inquire about their margin policies. Some brokers, if your margin level goes below 50% of your account balance, they will close your trade. Some brokers will allow you to go even below 70% of your account balance before they can close your trade. So let me show you how a margin call looks like. This is a notification from my broker, okay? Look at it. It will say you will receive an email, subject, margin call alert, account number. This is the account that you are using. They are going to define it and they will tell you urgent action is required. They will write, Dear Nguang Lanjunke, margin level of your trading account is below 100%. Should the margin level fall to or below 50%, some or all of your open positions will be closed automatically. So they are going to send you an email telling you, look, this is the situation of your account. You are below 50% of your margin. Our policy does not permit you to be in this trade again. If it continues to drop, you are going to close all your accounts and you will not be in this position again. So this is what it looks like. They will tell you your margin level is 85.90. Your required margin, the amount of money that you require to be in that trade, your collateral is 7.47, but what you currently have is 6.42. So you don't even have enough collateral to be in that trade. You're supposed to put 7.47 to be in the trade, but your account is currently 6.42. So you cannot be in this trade. You're already 85% below your account. So you are going to close this account. So this is how a margin call looks like. And when you get to this level, just know that you have blown your account. You are going to lose that account. Some of you will experience this in future when you don't manage your trade very well. But I pray that you don't get to that level. But this is how a margin call looks like. And I ended up losing this account from my broker. They will always send you a notification when your trade goes below a certain level that you cannot be in that position again. You will receive an email from them. So don't get to that level. Stopper level. Stopper level is when you completely run out of margin, like you cannot be in a trade again. Your broker will just close all your positions and they will say you have blown your account, you have lost that account. So I hope you were able to understand some of these terminologies. I didn't take time to read all of them, but that is simply what it's all about. I hope that you were able to learn something from here. I am still going to share this PDF in the group so that you're able to go through it. If there is still something that you did not understand very well, feel free to ask in the group, or you can still go through the notes and read. And we are here and we are available for you. For these calculations, like I said, we are still going to come back to it. I don't know how a PIP is calculated, how a lot is calculated. There is so much mathematics on that, so get yourself ready because you are going to go into calculations. What is the value of a PIP? You are going to know that if a currency pair moves from, if you are trading and a currency moves from 1.0985 to 1.0986, how much money have you made? We are going to calculate that, okay? If you use 3 lots, what is the value of 1 pip? If you use 2 lots, what is the value of 1 pip? If you use 10 lots, what is the value of 1 pip? How much money are you able to make? If the trade moves in your favor 10 pips and you are using a lot size of 3, how much are you making? If the trade moves against you 10 pips and you are using a lot size of 0.1, 0.2, 0.01, how much money have you made or how much money have you lost in the foreign exchange market? We are going to come back to this in future and I will show you how all of these calculations are done. I will show you how these values come about. I'll show you how these values come about. I'll show you how all of these values come about. I hope that you will be able to stay with us to the end, and if there is anything again that you need to be clarified, feel free to bring it up in the group and I will assist you. Thank you so much again for listening. This video was quite long, but thank you so much. I hope that you learned something. There's absolutely no way you can trade the foreign exchange market if you do not understand all of these things. That is why I had to take so much time so I could explain. Thank you so much. Be safe out there. Until I talk to you next time, goodbye.